Auditing Theory 6907, Chapter 7. PSA 240, the auditor's responsibilities relating to fraud in an audit of financial statements. Fraud refers to an intentional act by one or more individuals among management, those charged with governance, employees, or third parties involving the use of deception to obtain an unjust or illegal advantage. Fraud involves incentive or pressure to commit fraud, a perceived opportunity to do so, and some rationalization of the act. Management fraud. Fraud involving one or more members of management or those charged with governance. Employee fraud. Fraud involving only employees of the entity. In either case, there may be a collusion within the entity or with third parties outside of the entity. Two types of fraud are relevant to the auditor. Misstatements are resulting from fraudulent financial reporting and misappropriation of assets. Fraudulent financial reporting involves intentional misstatements, including omission of amounts or disclosures in financial statements to deceive financial statement users. It often involves management override of controls that otherwise may appear to operating effectively. This can be caused by the efforts of managements to manage earnings in order to deceive financial statements users by influencing their perception as to the entity's performance and profitability. May be accomplished by the following: manipulation, falsification, including forgery or alteration of accounting records or supporting documentation from which the financial statements are prepared, misrepresentation in or intentional omissions from the financial statements of events, transactions, and other significant information, intentional misapplication of accounting principles relating to amounts, classification, manner of presentation or disclosure, misappropriation of assets. This involves the theft of an entity's assets and is often perpetrated by employees in relatively small and immaterial amounts. Can also involve the management, who are usually more able to disguise or conceal misappropriation in ways that are difficult to detect. Often accompanied by false or misleading records or documents in order to conceal the fact that the assets are missing or having been pledged without proper authorization. Can be accomplished in a variety of ways, including embezzling receipts, stealing physical assets or intellectual property, causing an entity to pay for goods and services not received, using an entity's assets for personal use. Responsibilities of those charged with governance and management. The primary responsibility of the prevention and detection of fraud rests with both those charged with governance and entity and with management. It is important that management, with the oversight of those charged with governance, place a strong emphasis on fraud prevention, which may be reduced opportunities for fraud to take place, and fraud deterrence, which could persuade individuals to not commit fraud because of the likelihood of detection and punishment. It is the responsibility of those charged with governance of the entity to ensure, through oversight and management, that the entity establishes and maintains internal control to provide reasonable assurance with regard to reliability of financial reporting, effectiveness and efficiency of operations, and compliance with applicable laws and regulations. It is the responsibility of management, with oversight from those charged with governance, to establish a control environment and maintain policies and procedures to assist in achieving the objective of ensuring, as far as possible, the orderly and efficient conduct of entities' business. Inherent limitation of an audit in the context of fraud. Owing to the inherent limitation of an audit, there is an unavoidable risk that some material misstatements of the financial statements will not be detected, even though the audit is properly planned and performed in accordance with PSAs. The risk of not detecting the material misstatements resulting from fraud is higher than the risk of not detecting a material misstatement resulting from error, because fraud may involve sophisticated and carefully organized schemes designed to conceal it, such as forgery, deliberately failure to record transactions, or intentional misrepresentation being made to the auditor. The risk of the auditor not detecting a material misstatement resulting from the management fraud is greater for employee fraud, because the management is frequently in a position to directly or indirectly manipulate accounting records and present fraudulent financial information. The subsequent discovery of material misstatement of the financial statements resulting from fraud does not in or of itself indicate a failure to comply with PSAs. Responsibilities of the auditor for detecting material misstatements due to fraud. The auditor conducting an audit in accordance with PSAs obtains reasonable assurance that the financial statements taken as a whole are free from material misstatements, whether caused by fraud or error. An auditor cannot obtain absolute assurance that material misstatements in the financial statements will be detected because of such factors as following: use of judgment, use of testing, inherent limitations of internal control, the fact that much of the audit evidence available to the auditor is persuasive rather than conclusive in nature. The auditor should maintain an attitude of professional skepticism through the audit, recognizing the possibility that material misstatements due to fraud could exist, notwithstanding the auditor's past experience with the entity about the honesty and integrity of management and those charged with governance. Members of the engagement team should discuss the susceptibility of the entity's financial statements to material misstatements due to fraud. Risk assessment procedures. The auditor should perform risk assessment procedures to obtain an understanding of the entity and its environment, including its internal control. As part of this work, the auditor performs the following procedures to obtain information that is used to identify the risk of material misstatements due to fraud. Makes inquiries of management, of those charged with governance, and of others within the entity as appropriate, and obtains an understanding of how those charged with governance exercise oversight of management's processes for identifying and responding to the risk of fraud and internal control that management has established to mitigate these risks. Considers whether one or more fraud risk factors are present. This considers any unusual or unexpected relationships that have been identified in performing analytical procedures. Consider other information that may be helpful in identifying the risks of material misstatements due to fraud. Responses to the risk of material misstatements due to fraud. The auditor should determine overall responses to address and assess risk of material misstatements due to fraud at a financial statement level, and should design and perform further audit procedures whose nature, timing, and extent are responsive to the assessed risk at the assertion level. In determining overall responses to address the risks of material misstatements due to fraud and financial statements level, the auditor should consider the assignment and supervision of personnel. He also should consider the accounting policies used by the entity and incorporate an element of unpredictability in the selection of the nature, timing, and extent of audit procedures. Audit procedures responsive to risk of material misstatement due to fraud at the assertion level. The auditor's responses may include changing the nature, timing, and extent of audit procedures in the following ways. The nature of audit procedures to be performed may need to be changed to obtain audit evidence that is more reliable and relevant to obtain additional corroborative information. The timing of substantive procedures may need to be modified. The auditor may conclude that performing substantive testing at or near the period and better addresses and assessed risk of material misstatements due to fraud. The extent of the procedure applied reflects the assessment of the risks of material misstatements due to fraud. For example, increasing sample sizes or performing analytical procedures at a more detailed level may be appropriate. To respond to the risk of management's override of controls, the auditor should design and perform audit procedures too. Number 1, test the appropriateness of the journal entries recorded in the general ledger and other adjustments made in the preparation of financial statements. Review accounting estimates for biases that could result in material misstatements due to fraud, and obtain an understanding of the business rationale of significant transactions that the auditor becomes aware of that are outside of the normal course of business for the entity, or that otherwise appear to be unusual given the auditor's understanding of the entity and its environment. Evaluation and audit evidence. The auditor should consider whether analytical procedures that are performed at or near the end of the audit when forming an overall conclusion as to whether the financial statements as a whole are consistent with the auditor's knowledge of the business indicate a previously unrecorded risk of material misstatement due to fraud. When the auditor identifies a misstatement, the auditor should consider whether such misstatement must be indicative of fraud, and if there is such an indication, the auditor should consider the implication of the misstatements in relation to other aspects of the audit, particularly the reliability of management representation. When the auditor confirms that or is unable to conclude whether the financial statements are materially misstated as a result of fraud, the auditor should consider the implications of the audit. Management representation. The auditor should obtain written representation from the management that it acknowledges its responsibility for the design and implementation of internal control to prevent and detect fraud. It has disclosed to the auditor that the results of its assessment of risk that the financial statements may be materially misstated as a result of fraud. It has disclosed to the auditor's knowledge of fraud or suspected fraud affecting the entity involving management, employees who have significant roles in internal control, or others where the fraud could have a material effect on the financial statements. And it has disclosed to the auditor its knowledge of any allegations of fraud or suspected fraud affecting the entity's financial statements communicated by employees, former employees, analysts, regulators, or others. Communications with management and those charged with governance. If the auditor has identified a fraud or has been obtained information that indicates the fraud may exist, the auditor should communicate these matters as soon as practicable to the appropriate level of management. The auditor has identified fraud involving management, employees who have significant roles in internal control or other where the fraud results in a material misstatements in the financial statements. The auditor should communicate these matters to those charged with governance as soon as practicable. If the integrity or honesty of the management of those charged with governance is doubted, the auditor considers seeking legal advice to assist the determination of the appropriate course of action. The auditor should make those charged with governance and management aware as soon as practicable and at the appropriate level of responsibility of material weaknesses in the design or implementation of internal control to prevent and detect fraud which may have come to the auditor's attention. The auditor's professional duty to maintain the confidentiality of client information may preclude reporting fraud to a party outside the client and the entity. However, the duty of confidentiality may be overridden by regulatory requirements. If, as a result of misstatement resulting from fraud or suspected fraud, the auditor encounters exceptional circumstances that bring into question the auditor's ability to continue performing the audit, the auditor should consider the professional and legal responsibilities applicable in the circumstances, including whether there is a requirement for the auditor to report the person or persons who has made an audit appointment, or, in some cases, to regulatory authorities. Consider the possibility of withdrawing from the engagement and, if the auditor withdraws, discuss with the appropriate level of management and those charged with governance the auditor's withdrawal from the engagement and the reasons for the withdrawal. Consider whether there is a professional or legal requirement to report to the person or persons who have made the audit appointment or, in some cases, to regulatory authorities and auditors' withdrawal from the engagement and the reasons for the withdrawal.